Okay, let's start with the lecture today. Again, the lecture is optional, so I will just give you some background in this area. And we can talk more if you guys are interested in the future, but it is not a formal lecture for any means. And please start reviewing the machine learning basic lecture, the first 5 lectures. We will have quizzes starting Thursday, so please. Okay, last week we have assigned the first 3 lecture. I'm not sure because of homework you reviewed it or not. And we're adding 2 more actually in there. And they are very simple, short lectures with some basic background. We're going to have exercise on those in your homework assignment as well. And the midterm. Last time, we were talking about the first example. Example 1 actually is the option pricing. Suppose we have a stock price of $100. After a period, it can go to $200, double his price, or half of his price. I'm using this hypothetical numbers are just for easy to illustrate the concept, not necessary that's always there's to be. And then after we're done with these 2 examples, we come back to review how realistic these numbers are. Understand what I'm trying to say? But for now, I'm just trying to get the concept across. The main concept is we're trying to using one stock, okay, and one options to illustrate our example. And there are 2 different decision variables. One we call the X, one we call the Y. X represents the number of shares of the stock I'm going to purchase. Y represents the number of share of option I'm going to purchase or sell. And the Y actually, for the option, each one of the Y option, there is a price called C corresponding to it. So if I want to buy Y share of option, so the total cost will be C times Y in this example. We've done this before. And we can also purchase directly the stock on the market, which is X. The current price, assuming to be $100. And then the cost for me will be 100 times X. So those are the 2 things we set up to begin with. But after one period, we're assuming the stock price can either double or half. So either the stock price going to $200 or the stock price going to $50, half of it. So the net worth after one period either will be $200 times whatever share we have, or $50 times number of share we have. So far, okay? Simple math. Just walk you through one more time before we go into the second, because the second example are very similar to this example. So we want to make sure you understand the concept. We're interested in determining the appropriate value of C, the unit cost or the premium for purchasing this option. What is the proper C value? So here, currently, I'm buying X units of a stock at $100 per share and buying Y units of an option at a C dollar per share, and $150 for that particular stock after time 1. So possible outcome, which is the net worth, not the net worth, the value after this portfolio after one period will be $200 times the number of stock you purchase plus the $50 times y, which what is the $50 means? If the stock price going over to 200 and and the strike price will be 150, I'm going to make a net profit of $50 per share of option I have. So that will be $50 times y. If the stock price after one period dropped to 50, I'm going to choose not exercise the option and let the option expire worthless. Okay, worthless, meaning I'm not going to do anything with it. So the outcome after one period either is 200 times x plus 50 times y, or it's just 50 times x, either way. We're trying to see a so-called robust solution. We call that equilibrium. Equilibrium means doesn't matter what is the prices of the outcome, the stock price in the future, we're going to set it to equal. And we see the relationship between x and y. What the result is actually y equals to negative 3x, and meaning the x, which is the stock, purchase or sell, has to be what? Reverse operation with the option. Meaning if x is greater than 0, meaning we are purchasing stock. If x is less than 0, meaning I'm short selling stock. Understand what I'm trying to say? So any 3 units of x equals to the number of y you're going to purchase or sell. Same thing, y equals to positive number, meaning I'm purchasing this call option. If y equals to the negative number, I'm selling the option. Okay, I'm selling the option. We know y equals to 3x. Doesn't matter which side of this equation I plug in, the result will be what? 50 times x. Understand what I'm trying to say? So I'm replacing y in that equation with a negative 3x. They all end up with 50x, no matter what the stock price is going to be. The original cost for me to set up this combination of a stock and the stock and the option will be $100 times x. I'm purchasing how many shares of x minus minus 3x, which is minus 3x here equals y times c. Everybody see this? I'm just replacing the y equals to negative 3x. So each share of option is c, so c times y equals to negative 3x times c. Okay, just refresh what we have last time. Then I know the total outcome will be 50x. The initial investment will be 100 times x minus 3x times c. Is basically equals to what? 100 minus 3c, 100 minus 3c actually is my cost. So 50 minus 100x minus 3c equals to 3c minus 50. So this is my profit, or after this maneuver. So the outcome minus the initial cost will be x times the 3c minus 50. So this number equals to 0 when 3c equals to 50, correct? X is, I assume, is some positive number or negative number. So may not be 0. But if 3c minus 50 equals to 0, meaning I break even. That's the worst case scenario you could have. Understand what I'm trying to say? That's the worst case scenario. But we want this gain or profit is always be greater than 0, correct? Greater than 0. So it depends on this number, 3c minus x. If 3c is not equals to 50, boom, I can make money. The only time when I'm not making money is the 3c equals to 50. Make sense? We did it last time. So if 3C is greater than 50, this part is going to be positive. If I'm choosing X to be a positive, then positive times positive, I have a positive profit. If 3C less than 50, so this part will be negative, then I'm choosing a negative X at the time 0, and I will have what? Negative times negative will be still positive profit. So that's the maneuver I have. The discussion we have, first, if the unit cost of the C equals to 20, then 3C equals to what? 60, correct? Minus 50 will be positive 10. Make sense? So if I want to maintain the positive profit at the end, or gain at the end, I'm going to purchase 1 share of stock, just for example, then selling 3 units of options, so negative 3, then I will end up with $100 minus $60, okay? $60 equals to $50 initial cost. It cost me $40. So I need to have $100 to buy 1 share of stock. Everybody okay? And then $60 to selling the option. I have income of $60. So out of pocket, I spend $40 initially in the time 0. And then, however, the ending value at time 1 is always 50 times X, correct? Which is $50. So in this case, I'm making $10 in this scenario. Make sense? All right, fairly simple. Take a look at the next scenario. If the current option price is $15, 3 times C equals to 45 is less than $50, correct? Make sense? So this things I'm going to choose what? Short selling 1 share of stock right here. So X equals to -1, and buying 3 units of option, co-option. So initial cost will be what? Short selling the stock. I have income of $100 minus what? $45 I'm spending to purchase 3 shares of option. Make sense? 3 shares of option. In this case, initially I have a profit of $55 at the time 0. However, at the time 1, what do I have? Doesn't matter what do I have lost $50 at the time 1. Make sense? Since I'm doing the reverse. So the ending, I'm going to guarantee to lose $50 at the time 1 because the outcome always 50 times X. Now I'm choosing X equal to -1, so 50 times X, -1 will be -50. So initially I have what? $5 in my $55 in my pocket. I'm losing $50. I'm making a profit of $5 in the second scenario. Make sense? So this is guarantee have a profit unless C equals to 36.6666. Okay, so these are the possible scenario. After we review example 1, that's now talking about a little bit more maneuver. We're using 1 stock, 1 bond, 1 period, and 1 option, trying to do that. Okay? I don't know if you guys heard about called a money market account. Frequently in these trading places, in Scottrade, Ameritrade, and other online trading company, and we call these money market a special name called marginal account. I don't know if you heard about it. Marginal account is basically a money market account, like you put your money into the bank, usually you have checking account, correct? You guys probably all know that. And you're going to have a saving account, you know that as well, correct? Many times your saving account has a, what? Minimum credit, which means you have to stay a certain amount of money in that saving account. But there is a type of a saving account we call a money market account. The money market account, you need to keep certain balance. Also, you can borrow against based on certain credit line. Make sense? But you have to return it in certain number of period. Make sense? So these usually in these trading company, online trading company, we call the marginal account. Okay? So sometimes you can borrow money from the bank, basically, and then you do the investment. And after you sell the investment, and then you can repay your money market with a certain interest involved. Okay, this is what we're trying to do. So assuming the stock price right now is S dollars, after one period it can go to SU or SD. U usually greater than 1, and D usually less than 1, which means you either have a gain or you have lose certain amount of prices. And the other one is we call a riskless bond, usually we refer as a money market account. And presently worth $1. After one period, it becomes what? 1 plus R times 1 plus R dollars after 1 month or 1 year, and so on and so forth, based on what kind of interest you are using. Understand what I'm trying to say? All right. Value for a month after you do. Again, we are using the scenario we buying X share of bond and Y share of stock. Right here. X becomes how much I'm going to borrow, and Y is how many shares I'm going to purchase. After a month, it could be X times 1 plus R, which is what? Interest, correct? If I have cash in that account, we're going to have an interest yield with principal. Y share of stock, just Y share times SU or times SD. Depends on the stock price after a period. Everybody okay with me? Just symbolic algebra manner to represent this. So very similar to the previous example, this X dollar I have in the bank or borrow the bank will occur as interest bearing, okay, or interest pay in. Everybody okay? Depends on X's negative or positive. Make sense? And Y share of stock also could be positive or negative, but you have the two possible future outcome, S times U or S times D. Very simple. Nothing fancy. After stock for a period, S times U, usually we're using flip a coin, either is head or tail. So S1, which is the stock price after one period with a head as an outcome, and SD equals to stock price at time 1 with the tail as an outcome. So you can now playing with what? Not just half and half, 50-50%. It could be 60-40. It could be 80-20, correct? Depends on the sentiment of the stock prices trend. We call it trend or sentiment. So here we can using what? Simulation to do this. Understand what I'm trying to say? Or we can using Monte Carlo simulation. The best thing you probably learn in simulation is what? Random number generation, correct? We can using different type of distribution and sampling technique to study what is possible outcome. Or you can use what? The more theoretical models we exercise in homework 1. Remember this? The Black-Scholes formula to predict what will be the outcome of this. Remember in homework 1, we asked you to calculate the mean and the standard deviation, correct? Can I say, okay, S plus 2 standard deviation, or the future, the mean minus 2 standard deviation as 2 possible outcomes. Can I do that? Okay. And you all did that before. So first, we try to find an arbitrage. What's going on? So similar to the example number 1, can I find a proper value of x and y? Remember now, x is what? The share of a bond you purchase, correct? Y represent now is the stock you purchase or sell. So that the net cost is 0. So either I short sell the bond, which is what? Put money and buy the stock. So I'm borrow money from the bank, I'm buying the stock. So short sell the bond and buying the stock. You're certain you will not lose money and make a positive amount of money with a positive amount of a probability. That's what we're trying to find the positive bearing. Both x times 1 plus r, which is interest-bearing part of your bond, and y times SU or y times SD, we want them both to be positive or non-negative. So the worst I can do is equal to 0. However, I want to do better. Make sense? This is what we usually hope for. And also, in addition, I want the net investment to be 0. So that means the number of stock I'm purchasing times the number of share equals to the opposite direction of x. If I wanted to buy 3 shares of stock, each one is $100, so I need to borrow $300 from the money market account. Make sense? So initially, I don't have to come up with any money. Make sense? So if I want to buy 200 share, 2 shares, and each one is $100, I need to borrow $200. Make sense? If I short sell 2 shares at the $100 each, what I have? I'm going to have an income, initially income of $200, correct? I'm going to put this $200 into my money market account so I can earn interest for 1 period. So either way, I can operate this in reverse manner. Make sense? Either I borrow money to buy the stock, or I short sell the stock and save the money into the bank. Am I okay? Okay. So trying to understand this. And y is supposed to be equal to -1s times x. So now we have a relationship between x and y. It's actually the current stock prices I'm using in the reverse sign. Take a look. The real numerical example now is on. I'm going to illustrate this concept in a hypothetical data. Okay? Here, currently stock price is $4 a piece. U equals to 2, meaning after 1 period, the price can be $8, could be $8. Or D equals to 1/2. After 1 period, the stock price going down to what? $2, correct? Now it's $4, either goes to 8 or goes to 2. Up and down. These are hypothetical numbers. I'm just trying to illustrate the concept once more. Okay? And I'm not trying to say this is realistic. And we'll come back to talk about how realistic this example is. Understand what I'm trying to say? And here, R is what? The interest rate. For example, interest rate is 1/4 of what you borrow. It's pretty stiff, but it helps us to illustrate the concept once more. All right? And also, after 1 period, it could end up with $8 or could be end up with $2, either way. Supposedly, the strike price of a European call is $5 instead of $4 right now. So in the future, I can have an option available to me, expire in 1 period, actually cost me $5 to buy the stock. Everybody okay? And suppose further that we're beginning is with the initial wealth of X naught. X naught is I have $1.20 in my pocket at the moment. Okay? I have $1.20 in my pocket right now. I'm buying half share of stock. Half of the shares of stock cost me how much? $2, correct? Everybody okay with me? It will cost me $2 to buy half share. So I'm short of 80 cents. Am I right? Everybody okay with me? I'm short for 80 cents. So therefore, I'm going to borrow 80 cents from the money market account. So I have $2 to purchase that half share. Make sense? Yes? Very easy. I come back to talk about why I'm setting up $1.20 to begin with, and how we can come up with that $1.20. Understand what I'm trying to say? All right. Buying half a share. Since stock costs $4 piece at the time zero, we must, using my initial worth of $1.20, and borrow additional 80 cents from the bank, correct? From the money market account to purchase. That leaves us with a cash position of negative 80 cents. I borrow 80 cents. I own the bank 80 cents. After a period with what? 1/4 of interest, correct? I end up with owing what? The bank $1, full dollar. Make sense? I'm using this number just easy for calculation to illustrate the concept. Don't worry that much now. So if I borrow 80 cents after a period, I owe the bank for $1. All right? On the other hand, at the time one, I have the stock value at either $4 or $1. Make sense? So either go up to what? $8. Since I have a half share, what do? I can sell it for $4. I'm getting how much back? $4 back. I'm paying off what? $1. So I have a profit of $3. Make sense? Make sense? Everybody okay? But if the stock price went down to $2, since I have a half share, I only have $1 worth of the stock, correct? I sell it, get a $1 back, and pay off the $1 debt I have to the money market account. What is the payoff? 0. Understand what I'm trying to say? I end up with $0. So now, I want you to start thinking. With any kind of outcome, what is the worst I can do? Break even, correct? Yes? The $1.20 you lost that. And then we talk about how we get that $1.20 back. Make sense? Everybody okay? How can I get that $1.20 without any cost? You understand where I'm coming from? We're just assuming right now you have $1.20 in your pocket, all right? So later on, you're going to what? Lose that $1.20, somebody else's money, correct? You understand what I'm trying to say? $1.20 could be positive or negative as well if you operate reverse manner. Make sense? But the outcome is what? No matter what is, either you make $3 or you break even. For now. Understand the concept? One money market against one stock. So either you could end up with $3 or you can end up with a $0 break even. Let's take a look. So the game we set up just now. One bond, one stock, correct? The relationship we already know. See if we can replicate this exact same game using one option. So I need an option, which is what? At the time 1, with the strike price of $5, I can end up with either making $3 or I can break even. If I can do that, I just play this game in the reverse manner, I can cover everything. You understand what I'm trying to say? So now I have a money market, I have a stock, and I set up with a game. Now I'm looking for an equivalent option so that I can offset the game. You understand what I'm trying to say? So I'm finding an option with a strike price K with either outcome will be $3, which is fairly easy. If the stop price at 1 is going double, which is $8, everybody see this? Minus $5, well, I will have $3. Everybody okay? If the stop price went down to what? $2. $2 minus 5, I'm only taking the positive portion, meaning I'm not going to exercise that option. So I end up with a $0. Make sense? Make sense? Now the problem is, how much this call option worth? So I can make money. So I replicate the above game with one bond and one stock using an equivalent option, correct? But the option costs me something. Am I okay? Which is the C value I'm talking about. So see if we can, initial wealth of $100 needed to set up the replication, the portfolio described above, the non-arbitrage price for the option at the time 0, which is a C. Let's take a look. What's going on? Looking at two possible scenarios again, if I can find on the Yahoo Finance website with a strike price of $5, and I find somebody is trying to sell for $1.20, higher than $1.20, for example, or $1.21. Everybody okay? So I'm going to still buying half share of stock at the $2 per share at the time 0, borrow 80 cents from the money market. So the seller will invest extra $1.21, so I can sell it to $1.21. So our income will be $1.21 at the time 0. And minus the $1.20 I needed to set up this game, correct? $1.20 initial price, initial out of pocket I need. And I left over there was 1 cent. Everybody okay? Extra 1 cent as my leftover at time 0. And I'm going to save that into my money market account to bear interest. Make sense? So after one period, what I have, if the stock price is going up, one lose $3 out for the option, the replicate will have a $3 profit at the setup. So my break-even payoff is 0. Make sense? However, I have that 1 extra cent put in the money. Okay, so make me what? 1.25 cents profit at the end. Make sense? Make sense? So those two replicate go in opposite direction, cancel each other out, but the extra money I have saved, that's my profit. Next, if at the time 1, the seller will be able to pay off the option, I have this. Okay, let me see the other possibility. Scenario 2, if I can purchase the option less than $1.20, for example, $1.19 as I illustrated here. So it's cheaper than $1.20, correct? I'm going to buy $1.19 of the option on the market. Then I will buy the option and set up the reverse of the replicating game, which is what? I'm going to short sell the stock and what? Save that income to a money market account, which is $1.20, correct? Initially. So I'm getting $1.20 initially, and I'm going to save that into, and I'm spending $1.19 to purchase the option. So how much money I have end up with? Again, 1 cent. Make sense? 1 cent. And after one period, both outcome, possible outcome for this future stock price, I end up with a payoff of 0. But I have that 1 cent helping me make money. It's not a whole lot. Can I replicate this 10,000 times? Can I replicate this 5,000 times? 200,000 times? How much money I need initially? Zero, correct? I always have some extra cent put into the money market account. Make sense at all? I don't need to borrow too much money from other people. Yes, I do, but offset will balance it out. Did I make any sense at all for this? Okay. We're using a simple number to illustrate the concept, to set up. However, you can replicate the whole thing in multiple magnitude of you can afford or you have credit with. Correct? Initially, you may have a few $1,000s of credit, and after you become more sophisticated or history of trading, successful trading, the company will increase your, we call it line of credit for your marginal account. Did that make sense? All right. So you might ask a question, how risky this type of operation is. Am I right? You know you're going to have a short things to make money, and there's no risk for losing money. However, is the market still a lot of uncertainty there? How risky it is? So initially, we're trying to find the arbitrage, which means the payoff minimizes 0, and everything else could be positive. And we have to have a condition, which means what? 1 plus R, which is what? 1 plus your interest rate has to be between your U and D. So now you can figure it out. What is interest rate usually published by the bank, correct? What is your money market account, or what is your marginal account interest is? And many times they are not symmetric. It's probably more when you borrow money, less when you save money, correct? But at least you want to know this is between U and D. What is U and D? Either growth, possible growth for your outcome, or possible shrink in price in the future. Make sense? And these numbers, we know we can use what? Simulation, correct? Homework 1, we did a what? 500 paths, correct? So you're sampling 5 different paths of 120 time period each. And you can see the end price, correct? End of that contract or option contract, expiration date, what is the possibility of the outcome? Everybody okay with me? Okay. Only thing I want to demonstrate, I can making a simple plot for you to determine, okay, take a look. Only the yellow area, you cannot have arbitrage. Only on this area, you can have arbitrage, and everything else, and also on this blue line, you don't have to have any investment. Make sense? So this is using Monte Carlo simulation to verify this chart. We can do that easily. Okay, I think I'm not going to continue because after this is a little bit more theoretical. What it means is theoretical. We wanted to see if what is the possibility the stock price will go up? Make sense? Or is the possibility the price can go down, correct? So maybe 20-80, maybe 70-30. And you always using, we're going to talk about, oh, actually, we already covered this, the what? Forecast. The forecast don't tell you exactly the number is, but tell you a sentiment, correct? The sentiment means what? The trend of the stock price is going up or going down. And we have all these charting methods to predict. We don't know exactly the price is going to land, but I know it's coming up and in this range. Make sense? We have a confidence interval. And we can use those to set up my what? Option trading strategy. Make sense? But I'm going to stop right here. The most of the future development is how to determine the implied, okay, based on the forecast you have. And we can talk about more with that. Any question regarding this portion? How do you feel about this? Is not too much of engineer, but these type of thing we call the technical analytics, okay? Technical analytics on the financial investment. This can apply for commodity, can be applied for index fund, okay? Mutual funds with compounded asset, okay? And you can develop a derivative. And this is the method actually bank using to calculate the risk of a mortgage portfolio. Basically, you purchase a home and you borrow the money from the bank, right? You have a fixed 30-year, 15 years interest rate, and that the bank usually sell it to some other bank, and they pull all these mortgage together. Make sense? So the bank who borrow you the money, maybe here we have a Commerce Bank, we have a K-State Bank, right? But these are the people who come up with the cash to borrow to you, correct? Immediately, they sell it to another bank. For example, JP Morgan, correct? Or Morgan Stanley and other Freddie Mae, and those type of company who collecting the mortgage. And then blend them together, come up with another derivative we call the asset backing credit debt. And those type of things very similar to the operation for option trading. You understand what I'm trying to say? So I say, oh, this has nothing to do with the industry engineers. This is just financial operation. Yes, for this example, these example we introduce is something you see every day, right? And those are published in Wall Street Journal because those that are maneuver are fairly straightforward. All the financial instrument you are familiar with, stock, bonds, and mortgage, commodity. However, in the industry, ExxonMobil invests a huge drilling operation in North Dakota, for example, correct? For natural gas or shale oil. The investment is about, what? $60 million to begin with, correct? it takes 5 years to accomplish the entire project. You're going to have the $60 million sit there. You'll put it in a bank to accrue interest. And this is nothing too fancy for domestic investment, correct? You borrow bank US dollar, and you spending US dollar to your worker, to the material you're going to buy. What if this is offshore drilling operation? You're going to starting the drilling in South Indian Sea for natural gas, for example, and you paying what? You borrow US dollar from the bank, correct? But you're spending Australian dollar, or you spending euro. You're spending different currency. It's the $60 million you borrow today, after 5 years, are they still $60 million? Not at the current trend, correct? US dollar is sliding for the time being. So you borrow more than enough for your project of your industrial setting, or you building a factory in Mexico, for example, or Brazil. Is the money you borrow from the bank is still worth the same after 5 or 2 years of a project period? How do you make sure those money you borrow keep its value, even with the currency fluctuation? Understand what I'm trying to say? All the material, price of the material changes as well. So these type of concept, we call the hedge the risk, is frequently used in engineering as well. So here we're talking about advanced econ, same thing. You do a expansion project on your facility. How do you, one way is when do you pay it off? Second is, how do you keep the value of the money you borrow? Make sense? All right, I'm done with it today. Hopefully inspire you a little bit on what your future job could involve. Not necessarily just a financial instrument. This can be applied to your job as well. Majority of our graduate who works in the bigger corporation, their job is what? Project management or project as and one of the main job for the project manager is what? The spending and the cost, okay, the prospective profit, expenditure, or cash flow of the project. So the company is going to give you a budget. How can you keep the entire project within the budget? Okay, many of our graduates who working as a project manager, they actually make money just out of project operation because the initial budget they have. Make sense? All right. Thank you very much.